Welcome to It's the Economy. The Reserve Bank's monetary policy is less than 24 hours away, and there have been a few important changes in the past month that we will take note of. One, the government has kept fiscal deficit lower than expected, and that is a disinflationary sign. Two, the November and December CPI numbers came in lower than the Reserve Bank's own forecast, of course, lower than market forecasts. And three, most important, the Reserve Bank has provided liquidity of 2.5 lakh crore through variable repos and has brought down the call rate from 6.75 that it prevailed from August to Jan to 6.5% today. So, do all this mean we can get a dovish policy tomorrow? I have with me Ashhish Vaidya, the Managing Director and Head of Treasury and Markets at DBS Bank India, and Pranjul Bhandari, the Chief India Economist at HSBC India. Pranjul and Ashhish, thank you very much for joining me. Well, Pranjul, to you first. Inflation numbers down. Is all this adding up? I mean, deficit also down. Is all this adding up for a macroeconomic argument for the Reserve Bank to get more dovish?
Yes, I think so, Latha. It rarely looks so good because we have growth which is strong, but it is maybe going to be slightly softer in the next year compared to the previous year as the fiscal impulse turns a little negative, or as credit growth softens a little bit. So strong, but not so strong. We have inflation numbers that are likely to be much lower in the next couple of months. In fact, our sense is January inflation is at about 4.5%. I think we are at track at getting 4.5% for the year for FY25 as well, which is RBI's forecast. We have a rupee which is very well funded. If anything, there's appreciating pressure on the rupee, which again is good for inflation control. So it doesn't get better than this. And then, of course, you also mentioned the fiscal being extremely disciplined. So my sense is that, yes, in the next couple of quarters, as fiscal takes a slight step back, my sense is that monetary conditions will be eased slightly. It'll take a step forward. And I think, we will start seeing, we've already started seeing that in the sense that the call money rate has fallen from 675 to 650 already as the government has started spending. But my sense is the RBI will formalize this, maybe not as early as tomorrow, but my sense is, around June, middle of the year, they'll formalize it. And towards the second half of this calendar year, we can have some slight rate cuts.
Okay.
But I just want to take a step back.
What do you mean?
See too much easing.
What do you mean by formalize? You mean they will say stance change?
That's a toss-up. Or to be honest, the de facto stance is already neutral because the call money rate has come down and is now tracking the repo rate of 6.5%. But my worry is that they may not want to formalize it tomorrow. They may leave it for a couple of...
What do you mean by formalize?
So right now, the term that they use is withdrawal of accommodation.
Okay.
Maybe call it something like, we're happy with what it is right now, not withdrawal of accommodation anymore. Okay. But I don't think that'll happen tomorrow for the simple reason that you also see the RBI gets very nervous about a call money rate falling even a little bit below 6.5. So they're a bit worried that they give a finger to the market and the market grabs the hand. Okay. So I think tomorrow they won't rush into it.
Okay. Ashish, similar question to you actually, taking from what Pranjul says, the RBI gave 2.5 lakh crore, but the moment call went, even there was one tick below 6.5, they also did a reverse repo to take back the money. In fact, not one, but two. So, are you expecting anything, in the stance language or even in the guidance to change tomorrow?
Well, thanks for that. So, I think as far as the stance is concerned, I don't think they're going to, think anything around with the stance. I think it's going to remain at removal of liquidity or removal of accommodation. I think interesting things to understand and put it in the context is that since August, September last year, the government had, the RBI had clearly kept its deficit in the liquidity fairly tight. And that resulted in almost a 20-25 basis points tightening, which ideally is not really noticed by the market, but it actually trickled down into the real economy, and the deposits and credit rates actually moved up. So I think the actions in the last few days are clearly pointing towards a more comfortable situation. And I think the reversal also happens the way the tightening happened. So I think we will look at reversal on the liquidity, though they might not specifically say that. They will obviously say that the inflation is well managed because of tightened liquidity conditions, and accordingly, they will keep system fairly balanced. I think, and inflation continues to be on the priority. I think what interesting thing might happen is amongst the 5 MPC members, this time, every time you have seen about one member saying move it to neutral, this time probably you could see 2 members moving it to neutral. So that will give a sort of a soft indication to the market. But I agree with Pranjul that if you actually change the stance, then the market will really start multiplying the moves.
No, that's a very good one. So one thing, Ashhish, one thing we all should look for, therefore, is the vote. Will there be 2 people voting for neutral in the MPC? What other things train my eyes to what I should watch out for, either in the talk or in the statement?
So my sense is that I think in the last policy, clearly the policy was very hawkish on making sure that the inflation is the top priority. I think it continues to remain inflation a top priority, but I think they really pat themselves on the back, and it's actually worth it that they have really managed inflation well. And it's sort of, I really don't know, but I think the wordings will be a little bit softer than what we've seen last time.
Okay.
And that itself should be a good indicator as to how things will pan out.
Okay. So vote and wording. Pranjul, what would you watch out for? Are they likely to even lower the inflation forecast for the current year? Because clearly they are going to, go lower than their current forecast. You think they will show that, yes, inflation can be 5.3, 5.2 rather than 5.4? Anything like that this year or next year forecasts?
I don't think the FY25 forecast will be changed because I think it's just right at 4.5%. For this year, yeah, it could be nudged a little lower to closer to 5.2. But, they can do it this time or they can do it next time. I don't think they like to make change every single policy. So I don't think the guidance will really come from there. I think the guidance will mostly be on, their commentary on inflation, how, there is this disinflation that is going on, and whether they think it is long lasting and whether they are closer to their 4% target, the qualitative assessment of that. One other thing I'll be looking out for, and hopefully it'll get covered in the press conference that the RBI does, is this government not spending for long periods and government cash balance at RBI remaining extremely elevated for many months at a go. If this is going to become something that happens year after year, we saw it last year, we are seeing it this year, what is the RBI going to do? Because this starves the market out of liquidity for many months in a row. Maybe we needed it last few months because anyway there were food inflation pressures. But over time, over years, if we see this, then it could hurt a capex cycle, right? The private capex cycle. So what does the RBI do here? Does it use short-term rates, methods like VRR, VRRR to tide by these situations? Or does it go on to something like incremental CRRs, which I think you've discussed in other sort of panels as well? Although my sense is using CRR, which is a permanent tool for temporary, may just give extremely confusing signals. So what will the RBI change to tackle this situation?
Yeah, will there be an institutional answer? I mean, they have enough tools even right now. They can do a reverse repo to give the money to the banks, or they can do an OMO. They can buy bonds from the market. But all this will have other market implications. So will they have an institutional mechanism? And ICRR is a 15-day thing. So maybe that's an idea. But you expect anything as lasting as that, Ashhish? An institutional answer to answering liquidity, volatility?
No, I don't think I'm expecting anything of those. I think important to realize that there is the overall economic environment is quite volatile, and the current toolkit is sort of enough to handle that volatility. Only thing is the RBI has to be daily at it just to manage the liquidity. Okay. But I think I'm not seeing any move towards any institutionalizing framework of managing the liquidity.
Anyway,
I think the current framework is good enough.
Got it. Yeah, I guess they will work within the framework. If at all, it will be a longish discussion. But, they've sprung the SDF on us pretty suddenly. Just a year ago, they have put in institutions and instruments quite suddenly into the market. I wouldn't be surprised, but maybe this is not the hour. Ashhish, very quickly, what is the kind of range you are looking at? You see the 10-year, in case there is a slight hint of dovishness, go even below 7? And has the call rate peaked in your estimate as of now?
So, first of all, on the government bond markets, I think very constructive on the government bond markets, looking at how the fiscal is getting constrained, the fiscal deficit. Then, importantly, looking at the topping of the interest rate cycle, and coupled with that, the bond index inclusion. If overall global macros remain stable, I think we are headed directionally lower. And directionally lower, I mean probably about 675 to 6.5 over the next few quarters. Clearly, that's positive. On the liquidity side, on the liquidity side, I think we will look first at neutral liquidity and eventually moving towards a sort of a rate cut or a change in stance, so that the market indications enough. But the caveat to all this is that you need to be careful about any geopolitical events, and that could put a new spin in the wheel. I think one needs to be just careful about that. Otherwise, I think structurally, India is very well placed.
Ashhish, out of time. Ashhish, out of time. I'm sorry. I got it. Or actually, very sorry to stop you. I'm out of time. Pranjul, just one word. Will they increase the growth forecasts?
No, I don't think so. I think they're just right with their growth forecast as well. The governor has a personal preference for even higher number, but I think it's too early in the year to sort of make changes on that front.
Okay. Well, actually, TV Somanathan told us in the interview that he's working with 6-something for the next year. So he wasn't with the governor's 7. I was just wondering if we will get a full year forecast, right? The MPR is next policy. We will get a full year FY25 forecast from RBI? Pranjul?
Yes, I think so. Although I think it could also come in the next time. So it depends on them.
All right. Well, those are the things to watch out for then. Do they do something to the inflation forecast? What kind of a growth forecast do they give, if they give? But most importantly, as Pranjul and Ashhish say, watch out for the wording to see whether there is an indication that withdrawal of accommodation as a stance changes. There are some in the market, a few, who are betting that the stance can change as early as tomorrow. If that does happen, then, okay, we have seen the best of deposit rates. So all of you go and put your money in the best FD you get, because it's likely to be lower in the coming weeks. We'll wrap up on Bazaar on that note. Chartbusters coming up.